Good morning and happy Monday to all of you. Welcome to today's deep dive session. I'm so glad to have you join us here today. Can you believe it? It is almost the middle of June. We're really approaching the midpoint of the year, and it's been quite a year. Just looking back at where we were January, right? We had an interesting winter. Parts of the country got lots of snow. Other parts had a really mild winter with not enough snow. And here it is, almost the start of summer, summer solstice right around the corner. And more importantly for us, when we look at the markets this year, what an incredible turnaround, right? We started at the beginning of the year with a wide range of forecasts of what the market would be, just given what happened last year, right? As you may remember, last year we had quite a ride, right? Mortgage rates shot up, more than doubled, prices reached their peak. And so at the beginning of the year, you may remember, we had all kinds of predictions, from fairly upbeat ones all the way to dire ones. So here we are today, midpoint of the year, and I'm so glad to see you joining. Welcome to folks both on the East Coast, West Coast, and everywhere in between. I know that it's an early morning on the West Coast. You're thinking about lunch on the East Coast. It's good to have you here. And as we give everybody just a few more seconds to settle in, good to see everybody. The exciting thing for us in Richmond, it's been quite a spring season, I have to say. Looking at the real estate market here, it's a far cry from the concerns that a lot of people had. It's in a sense quite lively. We're seeing lots of buyers out and about, and as you probably experience in your own markets, a really tight market given the limited inventory. So with that, let me welcome you again officially to today's deep dive, and I'm going to bring up the slides I have prepared for you today, and begin to chat a little bit about home prices, right? We are at the midpoint of the year, and we're trying to take stock at what has happened in the market. And, generally the big question is, why are we looking at prices, right? In a sense, the price is not really a driver of market, yet it is, right? It tends to be a signal. What's the balance between supply, how many homes are available for sale, and demand, how many buyers we have in the market? And traditionally, the more buyers and the fewer homes, as we're seeing in today's market, prices tend to rise. The flip side of that coin is fewer buyers, more homes on the market, we tend to see prices lagging. And so this year in particular, I think it's so useful for us to take a look at what prices are doing, because we seem to be at one of those inflection points where there are contradictory signals in the market, expectations, forecasts muddied the waters, and of course, headlines didn't help as much. So with that in mind, here's the big question for me, and I think for so many of us in the market. What is happening with home prices, specifically now that we are approaching the tail end of June? And as you may remember, last year, June saw peak prices. As we come around this 1 year lap, what is happening with home prices, and what is that telling us about markets? And to kind of capture that and give us a little focus, I found this quote from Ali Wolf at Zonda particularly enlightening, in the sense what she's saying about the market, right? It's really challenging to time the market specifically. And in her case, she's got the lens of the new home construction side. But what she says next in that sentence, I think it applies throughout really the economy and the housing market. We need to try to block out headline noise and stay focused on long-term trends. And key here, I think, is that headline noise. And I say that because June of last year was the first time we saw roughly 2 quarters of decline in the economy as measured by gross domestic product. And that's when headlines really ramped up and started to say, we're in a recession, oh, we're not in a recession, but a really tremendously bad recession is about to come. There's a recession around the corner. Housing's going to crash. Prices are going to crash. Well, so many headlines were driving home this idea that the Fed, through its monetary tightening, was going to drive both the economy and housing into a deep recession, and we should be prepared for that. And yet, month after month after month, I was looking at the incoming economic and housing data, and there wasn't quite as much dire emergency in that. And so let's put some perspective on home prices. And what I have here, just for trend, like we're talking long-term trends, as Ali highlighted, I have Realtor.com's listing price. Generally, a lot of consumers, when they come to the market, they log onto a portal, and these are the prices they tend to see. This is their first sense of the market. And yet, as you know, as practitioners, asking prices are just that, asking prices. They can, depending on the market, be too high. And generally, as you know, there will be a discount from asking. Historically, that discount was somewhere in the 3 to 5% in a healthy market. At the same time, as we've seen in the last 3 years, asking price can just be a starting point in a bidding war, right? For a lot of buyers over the last few years, the asking price was just the floor, and then bids went over that asking price, and so the closing sale price was, in a sense, much higher. I'm only using this price as really a starting point to highlight the fact that June of 2022, we saw an all-time peak in listing prices. And so as we go through the following 12 months, so much of what we've been comparing, when we look year over year, month over month, we're comparing to these peak periods, right? What we've been calling the unicorn years of real estate markets in the last cycle. And so I think this is relevant, because anytime you compare something either to a really low baseline, think about this, you go from 1 to 2, it's a 1 unit change, and it's a 100% shift. You go from 100 to 101, again, 1 unit shift, and yet it's only 1% change, right? So whenever you look at minimums and maximums, changes can really sometimes be a little misleading. So with that, what happened after that peak? Well, we saw mortgage rates really go up during the June through November peak, where they shot up over 7%. Not surprisingly, listing prices combined 2 factors. 1, we had mortgage rates impact demand, but 2, and more importantly, at the same time, seasonality. You know, spring, summer, we see lots of activity, prices tend to ramp up, and then come fall and winter, prices tend to retreat. During this period is when we saw all those headlines basically say, well, the market is crashing, we're going to see a massive price correction, and we're going to see a housing market. People were comparing to 2008 or 9. And yet, when you look at 2023, the green bars on this chart, you see that the prices are telling a slightly different story. And so here I have highlighted for you January 2023, so this year listing prices compared to January of 2022. What do you see? That on a month-over-month basis, right, you compare listing prices from December to those in January, they were actually up about 3%. And even year over year, they were up about 1%. So in a sense, prices didn't really crash the way the media had portrayed we should expect them. You're in the market every day. You see the fundamentals. You've been seeing the tightness in inventory. You've been seeing buyers, especially now that we've had roughly 8 to 9 months of mortgage rates moving in a fairly narrow band, 6 to 7%. They've moved beyond the shock of mortgage rates are so much higher to the, well, these mortgage rates are here to stay. How do we navigate this? And so knowing that listing prices also reflect the mix of homes in the market, you've seen this, some months you have a lot of high-end luxury homes to come to market, particularly in sunny states. Think winter, Florida, California, Arizona. Lots of buyers flock to buy homes. In other months, the mix of homes may be skewed more towards the lower price. All of that can have an impact on prices. And that listing price mix of homes problem also impacts median sale prices, as you well know. So when we look at prices, and I know you do this on a daily basis, how do we analyze prices. And generally, we try to stick with repeat sale price indices. The best known of them is obviously the Case-Shiller, but several other organizations, CoreLogic, Black Knight, Federal Housing Finance Agency, the overseer for Fannie and Freddie, they have all replicated Case-Shiller's methodology in looking at the same home, trading hands time after time after time to really capture the change in value, right? Because that home that sold a few years ago for 100,000 sells for 110,000 today. It's the same home, basically, and we know that those prices represent the 10% increase in value. And so when we look at the price changes, we take two approaches. One is to look month over month, mostly because month over month really give us momentum indicators, particularly in volatile markets. When you're going from a peak market on a lower trajectory, or when you've hit a bottom and you're about to turn, the month over month reading gives you a nice quick view, especially when you have 2 or 3 or 4 months of that. It shows you momentum changing, either market picking up or market slowing down. Year over year, on the other hand, is really helpful in a stable, steady market because it removes some of the seasonal volatility, right? Higher activity spring, summer, lower activity fall and winter, and it gets you a sense of trend. So putting those two together, you have a much, much better, more nuanced picture of the market. And key to that, when we look at home prices over a long enough period of time, what stands out is the fact that they tend to reflect demographics, the economy, and market fundamentals. What we see here really are, this is from the Case-Shiller Index, home prices over a 1-year, 3-year, 5-year, and 10-year period. And you can tell even with the dire predictions of the last year, home prices are still in the positive. And so I think for a lot of consumers, the reason I say this, for a lot of consumers who are worried this year about their number one, prospects for finding a home, number two, whether it makes sense to even buy a home in 2023, I think it's important to help consumers understand that a long enough time horizon is really beneficial for a lot of folks who are in the right position financially, from a job standpoint and life stage to move forward with it. So looking at that month over month momentum, and then we'll compare some year over year numbers. What do we see? These are the latest numbers, and this is Freddie Mac also produces a home price index that looks at a repeat sales approach, so same home trading over time. You see here the slowdown from last summer, roughly in June, when prices really took a step back. They still rose in June, but they took a step back. You saw the impact of the second half of last year from mortgage rates, from headlines really instilling a lot of concern for buyers and sellers in the trajectory of the market. And then you see this rebound, January, February, March, April. We've seen solid, steady rebound in prices. Same picture with slightly different numbers for Black Knight. Same methodology. You see the same second half of the year softening and the rebound in the first 4 months of this year. And I think this was such a nice way that Black Knight's report captured it. They basically said, we're comparing home prices to a year ago. And so in a sense, you might see variation, possibly even slight decline. But Black Knight's view is at the current trajectory, annual home price growth would only fall modestly below 0% for a very short time before pulling back above water by late second quarter, so towards where we are, or early third quarter. Key here, and I think this is worth highlighting, firming prices nationally have erased more than 60% of price declines from late last year, and they are really on track to recover by mid-year. Not surprising to you, I know, because you're looking at market fundamentals. You know that inventory, even though active inventory has been growing compared to last year, still remains tight. In some markets, we're actually still seeing multiple bids this season. As I mentioned in my opening remarks, Richmond is one of those markets where for some buyers, it's been a surprising market. You know, they're going to market, they're finding more homes, and yet when they go to put an offer in, they're finding they're not alone. There are several other buyers at the table. Same situation we're seeing in CoreLogic's home price index. where you see the second half of the year softening and then a nice strong rebound in the first 4 months of this year. So you're beginning to see now multiple sources showing the same improving picture in the market, which is basically illustrating that for all intents and purposes, buyers are ready to move forward. And I know for a lot of sellers, the concern and fear of a lack of buyers has been holding them back. I hope that these numbers will give them encouragement. And here's what really absolutely I found so fascinating. Selma Head, chief economist at CoreLogic, in the latest pricing report, highlighted the fact that the recent trends suggest that home price growth this year, 2023, will fall in line with the historical annual average of about 4%. Just to take a quick step back in December of last year, a lot of organizations released their forecasts for home prices this year. And what stood out, they were basically, two organizations, Realtor.com, CoreLogic, that forecasted prices to be positive this year, to the tune of roughly 3 to 5%, and a lot of organizations forecasting prices to drop, some of them quite sharply. And in a sense, some of the forecasters who were positive were derided as Pollyannish, maybe having their rose-tinted glasses. Well, it turns out so far the market tends to show that maybe the folks that saw market dynamics, supply and demand imbalance, driving this year might have been right. But we're only at the half point of the year, so let's keep an eye out. Now, looking specifically by markets, I think this is such an important distinction I wanna highlight for you today. When you look at the top 20 metros that Case-Shiller tracks, what you see here, and this is the latest data, which is March, you see half of those top 20 in March had year-over-year lower prices. And when you look at which markets those were Seattle, San Francisco, San Diego, Portland, Phoenix, West Coast markets, which were already at record high prices and which have also seen over the last several months a real slowdown in tech sector employment. What's interesting, however, about these markets, when you look at more recent month-over-month trends, and I'll switch the slide, so pay attention to this, you will see the color change. When you look at month over month, all of a sudden, you're only seeing about 5 of the 20 markets seeing price declines. In fact, recent price momentum showing even in San Francisco picking up. Just to highlight it again, here's the year-over-year picture. Half the markets are in negative territory. Here's the month over month. Clearly, as we moved into spring, even in some of these markets, buyers returned and we're seeing a lot more traction in the markets. And in fact, this year-over-year, month-over-month distinction really comes into a clearer view when you put them side by side for some of these metros. You can tell that compared to a year ago, in a lot of these markets, prices were lower. At the same time, on a month-over-month in March, and since March, we saw CoreLogic and Freddie Mac, we saw these continue with that positive momentum. I expect Case-Shiller will show that too when they come out with the April data. You see the recent price momentum is picking up. Again, encouraging sign of a market as you would expect. The point I'm trying to drive home is 2023 is already looking a lot more like a typical housing market, unlike the unicorn years of 2021, 2022, which were anything but a balanced market. And so when we put a map view to this, right? Picture of being worth 1,000 words. Here's the year-over-year change in home prices. This is quarterly from the Federal Housing Finance Agency. And again, what you see here distinctly, Pacific and Mountain states, those which were already challenged by affordability concerns and which have also had a bigger squeeze on the tech sector employment, have been seeing sharper changes in prices. The rest of the country is really on solid footing. Moreover, when you take that picture and lengthen the time horizon, you can tell that even for those West Coast markets, by and large, homeowners are sitting on incredible amounts of equity given home values over the last 5 years, which is one of the reasons whenever people ask me, should I buy a home? I get that question quite often. I'm sure you do too. Should I buy a home? Generally, my question back as an answer is, how long do you plan to live in this home? How long do you plan to be in your job and in the community? If you plan to be there 3 to 5 years, this might be as good a time as any to buy a home. If you plan to be there less, whether you think you're going to move, your job is not secure, you don't have all your financial ducks in a row, then you might want to wait. You can tell over a long enough time horizon, for most homeowners across the country, it's been an incredible 5 years. So with that, I want to just highlight for you what's for us on sort of the looking glass for the week ahead. It's going to be a very interesting week from the data perspective. Number one, the consumer price index is coming out, so it will be one of the principal measures of the inflation. We're going to see what's happening with consumer prices. Number two, the Federal Reserve, the Federal Open Markets Committee, the rate setting committee, is meeting tomorrow and Wednesday. So on Wednesday, we'll have their decision on what happens to rates. I know we've been anticipating a variety of scenarios, one being that they might pause in June, one they might continue increasing. That will have repercussions through the economy and capital markets. We'll keep a close eye and keep you in the loop. Number three, retail sales give us a read on the health of consumers. And number four, mortgage rates. We've seen them pull back a little bit in the wake of the debt ceiling resolution. So it'll be interesting to see what this week's mortgage rates will look like. So for the week ahead, what I have for you is an encouragement. Our latest monthly market report is available for June 2023. If you haven't taken a look at it, absolutely check it out at trykcm.com/MMR. You can check out, get a wealth of insight into how markets are unfolding. And with that, I'm so glad you joined us today. I wish you a really successful and productive week, and I look forward to seeing you next time. Have a great and safe one.